Hello, everyone, and welcome back to the Rankard webinar series. My name is Niaja, and I'll be moderating today's webinar. And we'll be talking about credit scoring subscriber bases using machine learning. The subscriber bases we'll be talking about will be mainly telco focused. This webinar is part of a series of events that have been going on over the past few months, part of Rankard's 5th anniversary celebrations. We started off 2 months ago with conversational AI for brands, where we spoke about how brands could leverage automated training for customer support. Then we moved on to how brands could use digital rewards to boost sales. And now today we'll be talking about credit scoring using subscriber base. Credit scoring subscriber base is using machine learning, sorry. The focus of our talk today will be very broad, so it's more of a general discussion. We'll be talking about what credit scoring is as a topic. We'll be talking about the different kinds of algorithms that go into credit scoring solutions. We'll also be talking about the kind of data that is involved in building credit scoring solutions, especially in today's age where there's a proliferation of the amount of data that's collected on people. Look at the kind of data that is collected, how it's used, and how data privacy can be an issue. And then we also talk about alternative uses for credit scoring, where we are not just looking at credit scoring for taking loans, but also how having arbitrary scores that indicates the probability of customers to pay loans can be used in other areas. Today, I'll be joined by 3 speakers: Archibald Bernard Bedu, Raymond Brown, and John Jima. Now, all 3 speakers work at Rankard. John Jima is the Senior Manager for Business Operations at Rankard. He's in charge of platform and delivering all the solutions that we at Rankard provide. Archibald Bernard Bedu is a software engineer and data scientist here at Rankard with extensive experience both in deploying production-ready code and also deploying machine learning models across distributed environments. And finally, we have Raymond Brown. Raymond Brown is an experienced platform engineer and service delivery person who has been in the industry for over 10 years. So I'd like us to dive right into it. Like I said, today it will be more of a conversation and to not have too much of a lecture for you. So I'd like to start with John. John, if you could help us, when we say credit scoring, what exactly are we talking about and what comes to mind?
Interesting enough, when we talk about credit scoring, I think the only thing that comes to mind is a scorecard. So, what's a scorecard? But then again, scorecard about what? So I think the name qualifies it, credit. So basically the probability of a customer of a financial institution who wants a loan to be able to pay for the loan. So basically, if we talk about credit scoring, is the ability for a customer to be able to pay a loan or the willingness to pay. So for willingness to pay is based on a customer's past credit performance, and their ability to pay is supported by their current income and amount of outstanding debt. So it's interesting. So if we really talk about credit scoring, I think what comes to mind is the financial institutions, and in Ghana, as we have it, the regulator or the institution responsible for regulating this financial institution is the Bank of Ghana. So credit scoring as it is, I think currently we have just 3 main entities who are mandated to actually perform credit scoring in this country. So basically what they do is get information or data about customers, their financial information from the banks, from microfinance institutions, put this data together, collate them, and make it available in the form of a report to whoever have need of it. So I think in general terms, credit scoring is a scorecard that depicts your ability and willingness to pay off credit if given to you.
you very much. I think you made mention of what it is and how it's used in our setting. That's in Ghana. I was wondering if you could provide a little more, shall I say, of a history as to how credit scoring has been used traditionally, both in Ghana and outside of Ghana, and how it's evolving as a solution, again, both in and outside Ghana. I know for a fact that traditionally the kind of data that was used when trying to come up our credit scores would be maybe just your past loan repayments and the amount of loans that you've taken and all of that. But increasingly, more and more, what we are seeing is even data from, say, your social media usage and that kind of thing, it's coming into play. So a bit of a background as to what credit score has been and what it is becoming in the modern age.
Okay, yeah. So thank you. I actually thought that she was quite good at answering it, but let me give it a shot. So I think you rightly said it. Where in the past, or credit scoring as we've known it, it's more of on financial data. So basically, your payment for past loans that you've taken, even the amount of your income on a monthly basis, or even if you have side income, basically being able to aggregate all this data and based on that determine your willingness and your ability to pay off loan. But it's interesting you mentioned social media. So I think one aspect of the data source that has not really been considered is the qualitative data, or basically some other information that gives an indication of what a subscriber or a user's lifestyle is. So we talk about social media. Basically, by harnessing a user's social media page, you'll be able to understand their lifestyle. This even brings me back to sometime, I think in 2013, one of the products that Rankad worked on for a bank, I think bank in Nigeria, was to be able to profile their subscriber base based on their lifestyle. And the way we did this was to build an app and seed the app with content. So basically, considering the type of content that a user of the app is engaging with, we know that okay, this particular user has an interest in yachts, or maybe has an interest in mortgage, or has an interest in cars, or maybe wants some digital subscription or service. So being able to understand and know this about consumers gives the financial institution some knowledge of the customer to know that, okay, let's target a particular customer with a mortgage loan or a mortgage facility, or let's target a customer with a car loan. So this information now is available now on social media. You go to people's Instagram and what they like, what they post, and gives an indication of what their preference or their understanding is. Outside of that, so basically they let you know their taste. But then again, the fact that I'm posting something on social media doesn't mean that it actually gives an indication of my ability and my willingness to pay off a credit advance to me. But then again, your circle of influence, the people you are connected to, the people who engage with you, can be able to give an indication of your social relevance. So basically, for me, John, if you look at my social circles, it basically indicates the kind of people I engage with the most. Right, the people who like my comment, people who like my tweets and posts also give an indication. So basically, it's not just about the financial data, but it's about the other data sources that are not too obvious, but gives an idea of a user's socioeconomic value or their ability to be able to pay off a loan or even their lifestyle. So I think that's what I'll add to that.
Okay, thank you very much, John, for that. Archibald, like I like to put it in, like John mentioned, um, you are a go-to guy when it comes to, say, the algorithms and the AI and ML that would come into play when building a credit scoring solution. I'd like you to talk to us about traditional kind of algorithms that were used to build credit scoring solutions, and then we segue into how AI and ML has come into the mix and how the use of AI and ML to get credit scores is different as opposed to the algorithms that were used formerly. Archibald.
All right. Thank you, Niaja, for for this, right? So credit scoring or the scorecards were used by the financial institutions as a way to manage their risk, because they are giving out money and they want to know whether this person that I'm giving this money to would pay me back or not, right? So before I give my money out, I would want to know this person, right? So traditionally, I wasn't really interested in whatever they were doing elsewhere. I was interested in their financial engagement. Um, do they have existing loan history? How often do they pay their loans? Do they pay their loans on time? Right? Are they tied to other obligations where they have to give money out? Right? So these were some of the things that the financial institutions were looking at in order to determine whether somebody is ready to be given a loan, right? So I think they were doing were to take into they were taking about 5 things into consideration, right? And these 5 things contributed to a certain percentage of your total score, right? So let's try and then take a look at some of them, right? So the first thing they were considering was your payment history, right? And that was contributing to about 35% of your final score, right? So now, if we see payment history, right, what does it mean? Are you somebody who likes to take loans or who likes to take credit, right? Or you're somebody who just how do I say it? So the payment history, right, has to do with the individual account that you have. So if I have, let's say, one account and I use it to take loans and then pay back, right, and I pay back in time, right, it will give a very good indication that if you give me your money, I'd probably pay back, right? But if I open an account and then I use the account to take two loans, I close the account and I create a new one, right? That would give a very, very bad indicator as to whether I would pay back your loan or not, right? So payment history, right? They are saying that the payment history shows how you've paid your account over the length of your credit, right? So if you are given a credit or a loan of about 100 cedis and every month you are supposed to pay 10 cedis for a period of time, do you pay that 10 cedi on time, or you sometimes leave it for about 2 months and then just go and pay 20 cedis and then make things some way for the financial institutions? I think we can relate to this, right? Even amongst ourselves, if somebody asks me for money, right, and we come to an agreement that, oh, this is how you are supposed to pay me back, right? Every month, give me this amount, right? Now, if I give the money out and the person tries to put aside whatever we have agreed on, right? Instead of, so because I'll be, in a way, let's say I'll be expecting about 20 cedis for an amount that I've given you, right? And if you give me 10 cedis today, tomorrow you give me 15 cedis, right? You are trying to mess up the whole money I give you, right? So that's one thing that the financial institutions were taking into consideration, right? And when they are when they are considering this your payment history, they take certain things into consideration, right? They take your credit cards into consideration, how often you use your credit card. They take your retail accounts, right? The credits that you have from um, stores where you shop, right? When you go there, they take things on credit, right? These things, and then your installment loans, right? So, do you have other obligations? Have you taken other loans where you are supposed to pay in installments, right? And your finance company accounts, right? And then lastly, they were considering your mortgage loans, right? So your mortgage loans is like your rent, right? Basically, how much are you paying monthly, right? So things like that. Another thing they were considering was the amount that you owed currently, right? And then that's contributed about 30% of your score, right? So all these things I'm mentioning were the traditional approaches as to how they were able to determine whether person A is ready to be given a loan or not, right? And amounts owed is quite obvious, right? And the next thing they were considering was the length of your credit history, right? And then that was like 15% of your credit score, right? So having a longer credit history is positive for your scores, right? But it is not required for a good credit score, right? Some pointers that we should take into consideration is how long your credit accounts have been opened, including the age of your oldest account, right? So as I mentioned earlier, you don't want to open an account today, close it tomorrow, open a new one, right? And in a way, you have about you've opened about 5 accounts in 1 year, right? That is very, very bad to your credit, and then that will be a very, very bad indicator to your credit score. And how long specific credit has been opened, right? So taking so the first point made mention the rate at which you open your account, right? The second point talks about if you open an account today, how long does it take before you get to close it? The age of that particular account, right? And then the last point under the length of your credit history has to deal with how long it has been since that particular account was last used, right? So you don't open an account and then leave it idle, and then you expect that your credit score would be good, right? The next thing they were considering was your credit mix, right? So your credit mix is about 10% of your total credit score, right? And then the credit mix is the types of credit you have, right? The types of credit you have, and then they include a mix of accounts from credit cards, retail accounts, installment loans, and whatever you've discussed for your credits, for your payment history, right? The account you use in your payment history, right? If you have a very good mix of it, it would boost your credit score. And the last thing they considered under the credit score, right, or the traditional approach is the rates at which you open up a new account, right? So I think I've already mentioned this. Do you open a new account every 2 days, right? And then if you open it, do you use it, right? If you have a habit of opening an account every now and then, that would kill your credit score, right? So these were the things that they were taking into consideration, right? And you could see that even though it solved the problem, it's not exhaustive. You can't really apply this to a new user, right? So if the bank is new, okay, and the customers just came in, how would the bank know that person A who is trying to apply for a loan is credit worthy as opposed to person B, right? Because you might not have any financial history of that particular person, right? And that is where the approach of AI ML comes in, right? So we all know what AI is, right? We are trying to leverage on some past data, right, to come up with a new prediction when we see a new data, right? So and the reason why the AI or the ML approach was adopted was because it helps us automate things and help us calculate things faster. So imagine you are trying to process a loan application for about 1,000 people, and then you have to go through all the 5 things I've mentioned, trying to collate the amount owed, the payment history, the new credits, the length, and everything, right? You see that it involves a lot of work. Right. Now, what AI helps us to do is to automate all of these processes, right? And if you're able to automate these processes to make things faster, you're able to process the application faster. And then it's also devoid of human biases, right? Because if I'm a head of a financial institution and I see that Papaya is coming for a loan, Papaya might have a very, very good payment history, like really, really cool credit score, right? But because I just don't like Papaya, I would say that Papaya is not fit to be given a loan, and that alone, Papaya won't get a loan from that, right? So when we use AI, it takes away the human aspect of it, and it makes right in a way like it takes the human biases away, right?
Actually,
Yes.
so I would like to ask a follow-up question from you were talking about how AI and ML can take away the human biases.
Mm-hmm.
We know that AI and ML is trained on historical data, right?
Mm-hmm.
And there's a propensity for human biases to be in that historical data. Whereas, even though we saw the problem of I personally not liking you, but if I was your loan officer and I don't like you and I'm the one supposed to decide, in the case where since I'm a human being, I don't like you, I don't give you the loan. When we are using AI ML, that problem is solved.
Mm-hmm.
But what about instances where over a long period of time, the kinds of people that have been given loans are, say, a particular set. So maybe we always give loans to this group of people. If we train AI ML solutions on that kind of data, once we have the biases that we're trying to avoid, and how do we go about mitigating things like that?
All right. So the point you raised has to do with fairness when it comes to developing AI solutions, right? There are generally in developing these solutions, there are few data points where you don't take into consideration. Example could be the gender of the person, the race of the person, because historically these two data points has proven to introduce certain form of biases in ML models, right? So and then there are policies as well that tends to guide the building of these solutions because they directly affect human life. So there are policies where you have to go by and make sure that the data you are using is one way or the other not geared towards a specific use cases. And then most of the times too, these data sets is online, and a lot of people have access to it. And so, and then certain people are authorized to make changes or to even contribute to that kind of data set. And then there are a lot of eyeballs on it. So if somebody sees something that's it's deemed to be a red flag, the person can just voice it out, and then so right, and then the person can voice it out, and then that will be taken a look into, right? But I think there are like I can spot some differences when it comes to the human biases and then the biases that tend to occur in data set, right? If I know Niaja, right? Niaja might have a very bad history, but Niaja is my friend, and I'm the one in charge. Okay, I can just say that Niaja is good, Niaja is okay, so you should give the money to Niaja. But the ML model that doesn't know Niaja, right? The ML model knows a set of numbers or a set of values, and then it's based on that the outcome will be given, right? So there's no favoritism or things like that when it comes to ML model. It's not 100% let's say perfect, but there are certain nuances that it takes care of, right? So that's it. And there are also different kinds of data that people use, and then some of them too, they are not even dependent on historical data. They are based on what you do, and your lifestyle, as John mentioned earlier, right? So let me just go through some of the data points that these modern ML approach use, right? So they take into consideration your salary, how much you are earning, right? If for these data points, I think when it comes to a company like Bankcard, when the employees want to get a loan based on their salary alone, I think about 90%, or even I think everybody will get a loan based on their salary, right? The number of dependents, right? And then these are values that it's not as if somebody is sitting there trying to key it in, right? You are the one providing such information, right? And the number of credits and loans that you currently have, right? Your debt ratio, your age, right? Your total account balance, your car loan or your mortgage, right? And then social media activities, right? And then mobile applications, right? So I think there's a caveat that, as John also mentioned, that there's maybe whatever I do on social media is way different from the kind of person that I am, right? But it's not as if they are going to judge you on just one thing, right? right? They will take your history. They'll go to your Instagram, your Facebook, right? The things you talk about, the kind of website you visit, the things you look like, right? The things you look at, right? When you visit these websites, the kind of books you read, right? So they put all of these things together, and then also these days there are scenarios where they take data from even your mobile applications that you use, right? Whichever app that you use, they gather a lot of data, and then these financial institutions, they tend to leverage on these data as well, right? And also utilities data, right? How well you pay your electricity, your water, and any other subscriptions that you have. And then online transactions, right? So they look at your purchases online and see the things you have been buying, right? So if they see that you buy sneakers like papaya, right, it will be very, very hard for you to get a loan. Yeah. And then also there's the psychometric form filling, right? Or in that case, we can see it's a sort of um, behavioral assessment where there's a long list of question and answers that you're supposed to fill, right? And then when you choose these answers, these answers will be passed through a machine learning model, and it will categorize you as whether you are fit for a loan or not. So I think that would be the kind of data that is being gathered when it comes to the machine learning approach, right?
Um, Adato, if I may add to what Archie said. So it's interesting when he mentions all the various input or data that the model usually takes. But I think one thing of note is the fact that all the input or the data points are not weighted equally. So depending on what you want to use the score for, if it's for an insurance industry, or it's for a car loan, or it's for a house, the scores are weighted differently. So maybe how much you earn is weighted differently from how old you are. So depending on the industry, the weight for these data points are different. But talking about the ML model, so generally speaking, I think there are a number of them. But if we are to categorize them, we'll put them under two main categories. So we look at the statistical scoring model, and the one that we term as the judgmental scoring model. So basically, the statistical scoring model utilizes your credit history. So it's just one data source, your credit history. So if, let's say, for instance, I'm going for someone wants to run a report on me to get my scorecard, and I don't have any credit history, or I don't have any loan in the past, I mean, obviously there will not be any data on me. So basically, the institution requesting for the scorecard or the credit report will have to use another means of getting that information. So the statistical scoring model just use one data source, which is your credit history. The judgmental one, which is quite traditional and standard in most of the credit analysis, makes use of other sources of information. So basically, for the individual or the organization's financial statements, your bank references, your age, size, as Archie mentioned, to evaluate the borrower's ability to pay. And it's also not based on that. So once they categorize you based on your bank statement, your salary, your age, it puts you under a particular kind of category. And based on how the models calls this kind of this group of people, it uses that as an application to apply to this particular individual. So for all the models, you can put them under these two main statistical and the judgmental. And it's interesting when you mention the bias. And I think one thing that is of note, and that most of the ML models now are trying to address, has to do with the historical bias, which you rightly said. So let's say, for instance, I think I actually hinted on that. So if in the past, considering the kind of work that I do, considering where I find myself, the society I find myself, or even the time in life that I find myself, maybe just out of school, I took a loan, and because of that, I defaulted in certain scenarios. I mean, is that what is going to be used to judge on my ability and willingness to pay for future loans? Of course not. I mean, other things like the present scenario, your present state, should also be taken into consideration in making. So once you don't, the only source of data is not just the historical, but you're also taking the present. I think it helps eliminate the option of bias. And outside of the scoring model, I think they are in putting an application for credit, there are other information that you put in place. That's a different kind of model also analyze to confirm your willingness and ability to pay for the loan once given.
Thank you very much for that, John. Raymond, I'd like to bring you in here. So far, we've been talking about more traditional credit scoring models and the kind of data that is required. For subscriber base, especially for subscriber bases for telcos, what sort of data is available for telcos? And then we move to Archie and John on how we can use that sort of data to build credit scoring models. Raymond, if you may.
Sure. Thank you. Good day to everyone here. So, I mean, in Archibald's submission and John's submission, there was talk of if someone wants a loan and the bureau doesn't have information on the person, what can we do, right? I like you mentioned, these newer forms of ways of getting data can also be used to buttress what the bureau has. So for subscriber data, I mean, everyone has a phone, right? Everyone gets in touch. So what data does the telco have on you, and how can these bureaus leverage on this data to know if you are credit worthy and if you can pay for the money you are requesting for? Um, so let me start with one. So we have postpaid and prepaid subscribers. In other words, you have people who at the end of the month they agree to pay, commit to pay a certain amount, and you have people who are on pay as you go. And the telco has this data, and this can easily inform someone that for postpaid people, there are a group of people who are committed to pay a certain amount at the end of every month, whilst the pay as you go guys, I mean, you cannot really determine how much, but of course you can. And other data which the telco has on you is, I'm sure most of us know this. In most of the movies we watch, the sci-fi movies, if someone is making a call and they say track, I mean, where this call is coming from or where this call is going to, and so yes, if you pick up the phone and make a call, the telco will know the location where the call is originated from and where the call is terminating on the other end. This can be used to as fraud detection. So we know that when you say you are at this location, that's actually where you are. And yes, we have transactional data. So your top ups you do daily, data you buy. I mean, all this inflows and outflows on airtime. We can use that. I mean, the telco can easily use this data to try and gauge how much you spend, and if they give you this amount, you'll be able to honor back. I mean, there's so much data, but let me just walk through just two more. So even the type of phone you are using, right? If you pick up your phone and make a call, the telco knows what phone you are using. So you could be using an Android Samsung today, tomorrow if you change to an iPhone, the telco knows. So I mean, how easy will it be for you to give a loan to someone who changes phone every 6 months, as to someone who changes phone every 2 years? So that's data which the telco will also know. And I will not say recently, but Momo data is a wealth of information. Transactions on how much you sent in, how much you receive. So in a nutshell, that's just some of the data which I mean the Telco has and can harness in order to assist some of these bureaus determine your credit score and use it to give you a loan.
Okay, thank you very much, Raymond. So, Sean, looking at the kind of data that the telcos, or the kind of data that we have from subscriber bases, I'm wondering how it can be used both in at least augmenting the traditional credit scoring methods that we have, and also helping those who are traditionally underbanked and are not necessarily represented by the kind of credit scoring approaches that are currently being used by the banks.
Thank you, Ajay. So I think if you're asking about how it can be used, you actually answered that, right? So basically, there's a segment of the population that are underbanked or unbanked, basically mean that they don't have a bank account. So according to Statista, as of January 2021, we have about 42% of the Ghanaian population being unbanked. Unbanked means that they don't even have a bank account. The unbanked sector, often struggles with receiving access to credit because many of them do not have a regular fixed wage that will be processed through a savings, a loan, a microfinance, or even a bank. They actually engage because of their kind of employment where they engage in non-regular and short-term and informal employment. So the traditional credit scoring process, which includes the verifying of the customer's identity, as well as their willingness and their ability to pay, excludes this segment of the population. So I think earlier on when I started, I was giving some background into how the Bank of Ghana regulates this industry, and there's actually an act that supports this operation. So as we speak now, we have 3 licensed credit bureaus. I think is XDS, if I'm not mistaken, XDS Data, Dan and Bradstreet, and Hudson Price. So they are the 3 main credit bureaus. And the way it works is, the financial institutions are mandated to send reports or data reports, certain kind of reports to these credit bureau so that they can help them generate credit card or scorecards. Right. So for the unbanked or the underbanked, obviously you don't have this kind of data on them. But then again, these 42% of the population who are unbanked, they all use mobile phones. So Ray, I think, nailed it right there. Using that data, we can easily determine the unbanked's willingness and the ability to pay for credit or be able to pay for any credit that's advanced to them. So and the one main data source is the telco data. So telecom communications companies basically capture various data points on telco usage. So as I am here, I have a mobile phone, we even broke it down to a postpaid and a prepaid. So postpaid basically means that the telecoms know you, so you pay at the end of a particular cycle. And I think that there's a particular kind of package that you subscribe to. Prepaid is basically when I want, then I load my credit. So as and when I want to use it, and I will bet that the percentage of the postpaid is less than 1%. Most of them are prepaid. So how can you actually determine the credit worthiness of prepaid customers who buy data or buy airtime or transfer mobile money as and when they need it, right? So Telcom have subscriber information, your data, your SMS and your voice usage, your location, your top-up patterns, and most recently, mobile money transactions. So Telco data is obviously an alternate data source that can be considered when trying to predict the ability or willingness of a customer to pay. And the interesting thing is you can actually augment the credit scoring agencies with this particular data, because there's a lot more that you're able to gain from the telco data, the lifestyle of the customer. Ray said it, the location data. So in the incidence of fraud, okay, for the credit bureaus, there's no surety that even if I have a good credit report or scorecard, once I'm given the money, anything can happen. I can lose my job. I mean, something can happen. Then I'll put me in a position where I cannot be able to pay for the data. And because of that, I can decide to run away. I mean, if you don't see, I've written some, giving my location and all that, I can relocate. Okay, so all those are part of that. With Telco Data, what makes this interesting is the fact that you are able to triangulate the exact location of a customer based on where they are. So if they are receiving SMS at a particular location, you know that, oh yes, I mean, this is the location that you can find them. Secondly, I mean, in applying for these credit facilities, we usually add references, basically, so that they can be able to know that in case you run away, we can catch this person. I mean, I can just get somebody on the street and say, Charlie, I give them 10 cedis and say, can you, if I have the intention of committing fraud, and give them 10 cedis or some amount, and then Charlie, can you guarantee? Somebody will call you, just say yes, yes, something like that, right? I mean, obviously, the institutions have a means of validating this, but yes, it's possible. But you see, with the Telco Data, what makes it even easier for you to confirm that they are true references is the fact that you can easily also be able to determine the number, the people that you call the most. So if, let's say, for me, I put in Aja, I put in Raymond, I put in Archie as my references, yes, you can easily verify it. You can verify by looking at the number of times I engage. It might not even be voice call. Let's say data engagement, it could be SMS, something else. But if I'm saying that you are my reference, I mean, there should be some, I should have called in the past month, past 3 months. There should be some level of engagement that could verify that yes, you are somebody that I know. So, I mean, I think the telco data makes it possible for the unbanked and the underbanked to have access to credit, and not be singled out. Because, I mean, I think the informal sector is one of the sectors that is really driving the economy, and it would be sad to leave them out. And with mobile money actually gaining some increase in transactions, we see a lot of companies making use of that. I think I can mention the I think, and also we have the quick loans. I mean, honestly, just a disclaimer, I'm not sure how quick loans do their credit validation or the credit score, but you usually hear somebody saying that you want to send them mobile money for a service render. Say, no, no, don't send my mobile money. If you send my mobile money, it will vanish because the person has taken loan and he doesn't want to pay. So what kind of credit worthiness or credit check was done on that particular customer? So yeah, but what I'm trying to say with mobile money, it's even more important now to be able to tap into the telco data asset to ensure that for those that we grant credit to, we're able to guarantee their willingness and their ability to pay. Thank you.
Yeah, John, just a follow-up to what you mentioned. So this just came to mind. So you know MTN is the leader where they have where they are currently doing loans. Vodafone launched theirs not too long ago. Just like in the banking financial system where you have a user not being able to take loans from multiple facilities. Is it? I mean, it's something telco data would help. In other words, so that if you take a loan from MTN, until you pay, you'll not be able to take another loan from Vodafone. So that's just something which just came to mind. As one of the things could use telco data to.
So basically, we will term it as interoperability, right? So that the data assets or the data point is not only limited, the customer profile is not drawn just by being on one particular metric. I think so. It's similar to the credit bureaus, because for the credit bureaus, the way they work is not limited to one particular financial institutions. So all the financial institutions actually send their data to the credit bureaus for them to be able to draw a holistic report about a customer on their credit history. Yeah, thank you.
Thank you very much, Raymond and John. Archie, I'd like to ask if there are, so credit scoring as a concept, do you see any other areas where it can be applied outside of the kind of loans that we are talking about?
Well, I think the whole concept of credit scoring has to do with who deserves what, right? So, and even goes it goes beyond somebody who qualifies for a loan, right? Even it's in a way determines the interest you're supposed to pay on it, right? So if you have a very good credit history, you will get let's say a less rate, right? So if you take 100 cedis, you might end up paying, let's say, 110 cedis, right? But if you have a very not so good credit score, and then you manage to secure a loan, right? Your interest, sorry, might be higher, right? Because it's a risk, right? The financial institution is taking a risk of giving you that 100 cities, and if you run away, you are at a loss, right? So that is one. The second point is, in a way, it serves as some sort of recommendation. I remember some few days back, I wanted to sign up for one of these financial services, and they asked me to fill a form, right? So after choosing my answers, they told me that, okay, based on the answers that I've provided, this particular service would be of much help to me, right? So in a way, they went by the psychometric form of data gathering, right? They took my answers to a model. I don't know whether they had a model, whatever they had, and then the output determined the kind of service that I should be subscribed to, right? So that serves as some sort of recommendation, and even for some scenarios, it even affects the things you buy online, right? If you are to buy things online and you have a very, very bad score, you might end up paying much more. Even airline, I've heard incidents where two people go to an online portal for an airline, and they tend to have different price points, right? Because of most of these things, right? So these credit scoring concepts can be applied almost anywhere, right? So that is my small take on that.
Okay, so I don't know if you allow me, so just to add to what Archie said in terms of the I mean, I would want to take it from the industries who actually benefit from credit scoring, and the obvious one is always the financial institutions, the banks and the microfinance, because that's where people usually run to take credit facility. But interestingly enough, I think a new trend is coming up or will come up soon. But so for I know insurance companies, as Archie said, also well, what Archie said was basically towards the interest. But insurance companies also use that to determine your premium, what premium you should pay on the insurance that they are giving you. And I know some banks or some employers, so basically still in the financial institution, because of the sensitive nature of the role that they play, would want to have a credit history. So if you are someone who is don't have a really good credit history, you are likely to be prevented from getting certain kind of jobs. I mean, you never know. Maybe very soon, to our landlords will start asking for credit history so that they will see if you delay on rent payment or the like. So, yeah, thank you.
Thank you very much, John. It looks like there are no questions from our audience today. I think this will be a great point to stop. To end today's webinar. We've spoken about what credit scoring is, the concept as a whole, its history. We spoke about the kind of data that goes into building credit scoring models, and even how that data has been used in the traditional sense, and also with machine learning models. We also spoke about the new forms of data that we are having. And then we spoke about telco subscriber-based data, the kind of data that is available and how it can be used to both augment and maybe mix the current credit scoring methodologies up a bit. I don't know about you guys, but it's been incredibly informative and educative for me. Is there a question? Yeah, so it looks like we have a question. John, one of our listeners would like to know if anyone can get their credit reports from the credit bureaus that you mentioned. Is there?
Yes. So, I mean, if you get a chance, we can. If you get a chance, go to the Bank of Ghana's website. I think the whole act of the credit agencies is there. But as you've asked this, I want to touch on something. So not anyone at all is can request for your credit reports. There are certain institutions that are obliged to do that, or they are licensed under law to be able to ask for a credit report. And also, unless you give them the mandate to ask, I mean, they can. But I think I read somewhere that at least every customer has can request for a free credit report at least once in a year. So I think you can take that up. Yeah.
I don't know, but I'm
Thank you very
particularly
much.
interested in as to. I don't know why Papaya wants to know his credit history. Has he been making some bad purchases over the years?
Is it a question to me, because I'm not a credit bureau, so I don't think I'll be able to answer that.
Myself,
So I'm just quite. I want to know why.
the
I want to
audience
know
are the
why.
ones asking us. We are not the ones asking them the questions today.
Okay.
Unfortunately. So on that lighter note, I would like to say a very big thank you to everybody that joined today's webinar. And I'd like to thank our speakers, John Jima, Archibald Bernard Bedu, and Raymond Brown. Myself, I have and will always be Enes Niaja. Like I mentioned earlier, this is part of a series of activities marking Ranka's 20th anniversary celebrations. And there'll be more activities coming up, so you can check out our social media page on Facebook, Instagram, Twitter, LinkedIn, everywhere. We are Rancard, RANCARD. So you can check that out to see any of the upcoming events and any of the upcoming webinars. But for today, that will be all from us. Thank you once again for joining. Bye-bye. To everybody that joined today's webinar. And I'd like to thank our speakers, John Jima, Archibald Bernard, and Raymond Brown. Myself, I have and will always be Enes Niaja. Like I mentioned earlier, this is part of a series of activities marking Ranka's 20th anniversary celebrations. And there'll be more activities coming up, so you can